Good day from sunny Coral Gables, Florida. As we wrap up the first quarter of 2019, we see what patience and a steady hand can do to a portfolio that has been professionally constructed for the long run. The first quarter was in many ways a reverse of the fourth quarter of last year. If you went to sleep at the end of the third quarter of last year and woke up on April 1st, you would have thought nothing had happened, and yet much had. These 6 months are perhaps one of the clearest examples of believing in your decisions to invest for the long term and having the confidence that your professionally constructed portfolio can weather these unexpected periods of volatility. The current environment continues to challenge investors. We're now faced with concerns about the durability of the economy and earnings growth. We believe that the economy has entered a period of moderating growth. We think that earnings this year will be closer to normal rather than the outstanding growth numbers of last year. We don't see a recession, even as many have been touting one, based on the inversion of the yield curve between the 3-month and the 10-year Treasury yields. We believe there are issues that are making this inversion not reflect the economic environment, such as the competitive yields between the U.S. and Asia and Europe, where we still see some zero interest rate environments. Keep in mind that markets normally are a forecasting mechanism. What we see today as far as valuations is a reflection of what the majority believe will happen in the next 6 to 9 months. However, sometimes these levels get pushed to extremes due to trading forces such as high-frequency trading. We continue to believe that as we enter this late stage of the economic and profit cycle, investors can manage their portfolios for success. We believe that an increased emphasis on seeking yield is in order. When appropriate, we encourage the use of good quality dividend-paying companies, covered call writing, master limited partnerships, and other investments that have shown to have a lower correlation to the markets and good yields. International markets continue to be challenged, both developed and emerging. While we like the valuations in emerging markets, we believe that a sign that it's opportune for increasing this exposure will be when the dollar weakens. Looking ahead, we believe in the continued growth of the U.S. economy, albeit at a slower pace than we saw last year. There are too many economic watchers out there, and we believe actions will be taken as necessary to keep the economy growing. If you'd like to schedule some time together, you can do so by going to our website. You'll find a button on the left side to schedule a phone call with me. We look forward to hearing from you and wish you much success with your investments. Thank you.